Iamgold missed Wall Street consensus for the second quarter of 2026 on both the top and bottom lines.
Completely missed it.
Yeah, revenue came in at $856.9 million, which missed the $932.83 million estimate. And adjusted EPS was 42 cents, missing the roughly 50-cent forecast. Full-year attributable production guidance was firmly reaffirmed at 720,000 to 820,000 ounces.
Right.
But despite the consensus miss across the board, the stock actually surged nearly 10% after hours, and it eventually climbed over 13% to that $24 to $25 level.
It was a massive rally.
Okay, let's unpack this. Missing consensus by that much but watching the stock rocket is like failing a math test but getting a full scholarship anyway.
Yeah.
What is the market seeing in this report that the headline EPS missed?
Well, the market is basically looking right past that income statement. They're staring directly at the cash flow and the balance sheet.
Because the paper earnings are sort of an illusion right now.
Exactly. I mean, in the mining sector, accounting earnings, that EPS number, it can be heavily distorted by non-cash items. When you have these massive newly built assets finally coming online, you get hit with enormous depreciation and amortization charges.
Right, which drags down your net income on paper, even if it doesn't cost you actual cash in that quarter.
Exactly. So the stock reaction you saw, it wasn't about the accounting profit at all. It was entirely about the underlying cash generation driving this truly massive balance sheet transformation.
Right. So if you're an investor and you're just looking at a basic stock screener, the paper profits look a bit light.
Yeah, they look terrible.
But the actual physical cash hitting the corporate bank account tells a totally different story.
A completely different story. I mean, look at the mine site free cash flow. It hit $368.9 million just for the second quarter.
Wow.
Yeah, that is a 163% increase year over year. And if you zoom out to the year-to-date figure, they're sitting at nearly $900 million in mine site free cash flow.
$900 million? That's just wild.
It's almost $1 billion in free cash flow in 6 months. So that completely reframes the narrative of an earnings miss. It explains why institutional capital rushed into the stock the second the market opened.
What's fascinating here is how quickly this cash generation allowed a mid-tier miner to deleverage. I mean, historically, the space is notorious for drowning in debt.
Oh, absolutely. The heavy capital expenditure phase of building a new mine usually wrecks their balance sheets.
Right. And just 1 year ago, Iamgold was carrying $876.2 million in net debt. They were highly leveraged.
Which is incredibly risky with volatile commodity prices.
Exactly. But today, they have completely wiped that debt out. They actually moved to a net cash position of $52.2 million. They erased nearly $1 billion of net debt in a 12-month window.
You just rarely see that kind of financial turnaround outside of tech companies. Definitely not in a heavy industry, earth-moving business.
So what's our total liquidity looking like now?
Total available liquidity is sitting at $1.35 billion right now. And that includes an undrawn credit facility of about $845.7 million.
Undrawn, meaning they don't even need to touch it.
Right. They actually just paid off the remaining $100 million balance on that facility in the second quarter. So they're operating with a totally unencumbered balance sheet.
And based on the sources we're doing this deep dive into, they aren't just hoarding this cash either, right? They are aggressively returning capital to shareholders.
Very aggressively. In Q2 alone, they bought back 8.6 million shares for roughly $147.9 million.
And if you go back to December 2025, they've repurchased almost 27.9 million shares for over $510 million.
Right.
They are basically taking a huge chunk of their mine site free cash flow and just handing it back. But that raises a very practical question for you if you're holding the stock.
Sure.
You don't wipe out $1 billion in debt and fund a $500 million buyback by magic.
No, you definitely don't.
Where is this massive war chest actually coming from? Specifically, how are they funding all this without tapping into debt?
To answer that, we really have to shift our focus to the operational metrics of their three main assets. We need to look at the actual dirt being moved, starting with their absolute cash cow in Burkina Faso, which is the Essakane mine.
The real engine of the company right now.
Exactly. Essakane produced 88,400 attributable ounces in the quarter. That's up 15% year over year. But for anyone tracking the cash, the real story here is the dividend that was upstreamed from the local operating entity.
Right. They declared a massive dividend of roughly $500 million from their 2025 profits.
Yeah, and since Iamgold owns 85% of that asset, their net portion is about $400 million. They received almost half that in the second quarter alone, which directly funded those share buybacks.
So that influx of cash crossing borders from West Africa is just direct fuel for repurchases in North America.
Precisely.
And then moving over to Quebec, you have their Westwood mine. It's the smallest of the three, producing 32,400 ounces.
Which is still a 10% increase year over year.
True, yeah. And the technical notes actually point out this was driven by hitting a really solid grade of 8.34 grams per ton, and also some improved stope mucking and hoisting.
Right. Those operational optimization metrics are huge for underground mines.
Yeah, I want to break down those mechanics for a second because it matters for their margins. Stope mucking is essentially the process of clearing out the blasted ore from the underground cavities.
Yeah. You have to get the rock out of the way before you can do anything else.
Exactly. And hoisting is, actually getting it up to the surface. So it sounds like they just eliminated a major bottleneck in how they physically move the rock.
Material movement is everything underground.
Right.
Westwood relies heavily on moving that high-grade ore efficiently because your fixed costs are so steep.
Right. Hitting over 8 grams per ton is great, but if you can't hoist it to the surface fast enough, your mill just sits idle.
And you just bleed cash. By clearing the bottlenecks in the skip hoists, they increase the volume of rock they can move per hour. That directly translates to more ounces poured and a lower cost per ounce.
Makes sense. But as vital as Essakane and Westwood are for current cash flow, the entire future valuation of Iamgold really hinges on Côté Gold in Ontario, right? This is their growth engine.
Oh, absolutely. Côté is the focal point for the market right now.
They produced 67,300 attributable ounces there in the second quarter.
It's a massive, long-life, generational asset, and it's currently in its critical ramp-up phase. The second quarter showed exactly why institutional investors are so optimistic about it.
Because in June, the processing plant finally reached near full capacity.
Right, but getting a mega mill to full capacity always involves some serious growing pains.
Yeah, the technical reports noted they had to replace a major conveyor belt, and they actually had to commission a second cone crusher.
Yeah, the early ramp-up phases of these massive metallurgical facilities, they always uncover bottlenecks. At Côté, the primary crushed ore just wasn't getting to the high-pressure grinding rolls efficiently.
The HPGRs.
Exactly. These high-pressure grinding rolls, they use immense pressure between two massive spinning cylinders to pulverize the rock. They're incredibly energy efficient.
But I imagine they're sensitive to the size of the rock you feed them.
Oh, very. If you feed them rock that hasn't been properly pre-sized, the abrasive wear on those rollers is just catastrophic.
So that's why they added the second cone crusher to handle the pre-sizing.
Precisely. It ensures the rock is optimally sized before it hits the HPGR. And that one single fix extends the life of those grinding rollers from needing replacement twice a year down to just once a year.
Wow, so you cut your maintenance downtime in half.
And in mining, maintenance downtime is your biggest enemy. Slashing it drastically improves the mill's availability.
And you can see the financial impact of that mechanical fix almost immediately. Processing costs at Côté dropped from an average of $22.50 per ton down to $17.72 per ton in June.
That is a huge drop.
Yeah, and management is actually tracking toward a target of $15 per ton by the end of the year.
Taking that much of your processing costs out in a matter of months is a textbook operational turnaround.
Here's where it gets really interesting, though. With all this cash flooding in and the fixes working perfectly at Côté, management made a very deliberate choice. They officially deferred the massive capital expenditure expansion for Côté.
Yeah, the expansion that would have taken it from 40,000 tons per day up to 50,000 tons per day.
Right. We're talking a $500 to $750 million CapEx project just put on ice. Instead, they're prioritizing optimization of the current 40,000-ton rate and focusing on integrating the neighboring Gosselin deposit.
Which, by the way, now boasts a measured and indicated resource of 20.3 million ounces.
Okay, let's unpack this. I have to push back on this strategy. Missing consensus by that much but watching the stock rocket is like failing a math test but getting a full scholarship anyway. But regarding the expansion, you have a historic gold bull market, you're swimming in cash, and you have this incredible asset. By delaying the 50,000-ton expansion, isn't management basically capping their near-term upside just to play it incredibly safe with capital allocation?
It's a totally fair question, and honestly, analysts aggressively pressed management on this during the earnings call.
I bet.
But this raises an important question for you as an investor listening to this. Do you want sustainable value creation, or do you want short-term volume chasing?
I mean, I want the most profitable option.
Right. And management's discipline here is actually a massive positive for the structural safety and long-term profitability of the mine. It all comes down to mine sequencing and margin optimization.
Walk me through the engineering logic there. How does moving slower make them more profitable?
Well, by staying at that 40,000 tons per day rate, Iamgold can systematically maximize the depletion of the main Côté pit. The timing of when that main pit empties is critical because of a concept called in-pit co-disposal.
Okay, what is that?
When you process ore, you are left with massive amounts of tailings and waste rock. Managing that waste is one of the most expensive and environmentally sensitive parts of modern mining.
So instead of spending hundreds of millions building massive new surface tailings dams for the new Gosselin deposit.
They just put the waste back into the hole they already dug at Côté.
Oh, wow. That's actually brilliant.
It is the masterstroke here. If they ramped up to 50,000 tons per day right now, they would process the ore so fast that they would have to start mining Gosselin well before the main Côté pit is fully empty.
Which entirely ruins the co-disposal strategy.
Exactly. It would force them into massive, immediate capital expenditures to permit and build new surface tailings infrastructure. So the 40,000-ton rate is the absolute sweet spot.
It maximizes cash flow today, minimizes capital intensity tomorrow, and lets them integrate a 20 million ounce resource over time.
Without wrecking their balance sheet.
Okay, that makes perfect sense. It's not about capping upside, it's about engineering the highest margin sequence for the next 2 decades. But speaking of margins, we need to transition to the unit economics. While the cash flow and production narratives are stellar, we have to look at the costs to give you the full picture, and those reveal some very real margin pressures.
The cost side of the equation definitely requires scrutiny. Their all-in sustaining costs, or AISC, came in quite high at 2,271 wells per ounce for the quarter.
That is steep.
Yeah, and their cash costs are tracking toward the upper half of their annual guidance. Getting an ounce out of the ground and sustaining the operation for over $2,200 is historically a very high floor.
Where's all that cost coming from? I mean, I imagine basic inflationary pressures, specifically energy, play a big role.
Energy is huge. Brent oil prices ran $25 to $30 above their internal guidance assumptions. And in a heavy earth-moving business, diesel is your lifeblood.
Those massive haul trucks burn thousands of gallons a day.
Exactly. That oil price variance alone added about $35 per ounce to their costs.
Sure, inflation we expect, but there's a more structural cost buried in this report that actually punishes the company for its own success, right? The sliding scale royalties.
Oh yeah, the sliding scale is a huge factor right now.
The average realized gold price in Q2 was incredible, sitting at $4,384 per ounce. But because their royalty agreements scale with the price of gold, those payouts just exploded. It's like driving through a toll booth where the ticket price goes up the faster you drive.
It's a critical dynamic for investors to understand. Royalties aren't always a flat 1% or 2% fee. At Essakane, royalties accounted for a massive chunk of their cash costs. In total, the higher realized gold prices added a massive $380 per ounce to Essakane's costs.
Wow. And at Côté?
At Côté, those sliding scale royalties added $309 per ounce.
So the higher the gold price goes, the disproportionately higher their costs go. And then you layer on the geopolitical and tax realities.
Right, Burkina Faso.
Yeah. In Q2, Iamgold had to make a $74 million catch-up tax payment to the government there. Plus, going forward, they expect to pay $35 to $40 million quarterly, alongside a $26.8 million withholding tax just for that new dividend.
The geopolitical reality of mining in West Africa is that you have to share the wealth when times are good. Host nations design their mining codes to capture windfall profits during commodity supercycles. The government of Burkina Faso knows exactly where the gold price is trading.
So what does this all mean for the retail investor? Between the sliding scale royalties, the fuel inflation, and the massive tax hits, does this essentially put a ceiling on how much they can actually benefit from this historic gold bull run?
It can feel like that.
Right. Are you basically buying into a company running on a treadmill where costs just rise to eat every new dollar of gold price?
If we connect this to the bigger picture, you have to separate percentage margins from absolute cash flow. It is true that the percentage margin is being squeezed on a per ounce basis.
Well, tie chart looks different.
Right. However, absolute cash flow is what pays down debt and funds buybacks. The sheer volume of high-priced gold they're selling easily out-earns the inflation of inputs. Think of the math this way. A $4,300 gold price absolutely triggers higher royalties and taxes. But even after those payouts and the higher diesel costs, the net cash remaining per ounce is exponentially larger than it was when gold was at $2,000.
So the net cash position is highly secure because the top-line revenue expansion just completely dwarfs the unit cost inflation.
Exactly.
That is a crucial distinction. It's the difference between a margin percentage looking compressed on an analyst spreadsheet versus actual physical dollars piling up in the corporate bank account.
Exactly right.
Weighing that incredible cash generation against the royalty and geopolitical risks naturally brings us to the long-term outlook for the stock. For your portfolio, what are the key milestones you should be watching in the coming quarters?
Well, there are a few major catalysts on the horizon. First, in the fourth quarter of 2026, we are expecting the updated Cote technical report.
The blueprint for the next decade.
Yeah, this will officially integrate that massive Gosselin deposit into the mine plan. It'll give the market the definitive look at the long-term production profile and outline those expansion scenarios we discussed.
What about their cash cow in West Africa?
For Essakane, look toward the first half of 2027. They're going to release a mine life extension study, potentially pushing the life of that asset out to 2035.
If they can secure another 8 years there, it drastically reduces the pressure to go out and buy replacement ounces in this crazy M&A market.
Completely de-risks their production profile.
And perhaps the most interesting catalyst for the income-focused crowd management heavily hinted at initiating a regular dividend in early 2027.
Provided they maintain this net cash position, of course.
Right. They are already buying back shares, but a regular dividend would open the stock up to an entirely new class of institutional yield-focused funds.
It would signal a complete transition. They'd graduate from being a heavily indebted turnaround story to a mature, yield-generating mid-tier producer.
And this raises an incredibly provocative final thought to chew on. Looking at the broader market context, UBS recently put out a projection seeing gold hitting $5,000 per ounce by the first half of 2027.
That's a huge target.
We just established that Iamgold wiped out nearly $1 billion of net debt in just 12 months, with gold averaging around $4,300. What happens to their capital allocation if gold hits $5,000?
At that point, they wouldn't just be buying back shares. They'd be generating so much free cash flow they could become a major acquirer themselves.
Or, paradoxically, their completely clean balance sheet, the operational Cote mega mill, and massive cash flow could make them a prime acquisition target.
Oh, absolutely. A senior miner looking to buy instant de-risked production would be looking very closely at them.
It entirely changes the game board. A debt-free miner producing 800,000 ounces in a $5,000 gold environment isn't just surviving, they are dictating terms to the rest of the sector. If you're building out your portfolio, make sure you hit follow on whatever app you're listening on so you never miss our daily deep dives into the earnings reports that are actually moving the markets.